and welcome to my channel, The Finance Fix with Dimuj. Today, we are diving into VCE Accounting, specifically Units 1 and 2, focusing on the topic Financing a Small Business. In this lesson, we'll go through the key concepts behind financing a small business, followed by a series of detailed practice questions. Toward the end, we'll also work through some exam-style questions to help you prepare effectively. Before we jump into the answers, I recommend you pause the video when each question appears, take a moment to read it carefully and try answering it on your own. Then continue watching to review the correct answers and explanations. So, why wait? Grab your notes, stay focused, and let's get started. This topic covers essential concepts in financing a small business. By the end, you'll understand different sources of finance, how interest is calculated, flat versus reduced imbalance and effective rates, and the factors that influence loan approvals. You'll also learn about gearing, the balance between debt and equity, how to calculate return on owner's investment, and how gearing affects that return. We'll also cover a range of key terms related to financing a small business. So by the end of this video, you'll be more familiar and confident using them. So there are two sources of finances available for small businesses. They're called internal sources and external sources. We'll go through this in more detail in the next slide. Internal sources of finance come from within the business. So they can be proprietor's capital, means when starting a business, a sole trader often invests personal money or assets. This is known as the owner's capital and usually forms the main sources of finance for small businesses. Then they have retained profits. Profits earned by an established business can be reinvested instead of being withdrawn. The portion kept in the business helps fund future growth and operations. And then they have support from friends or family. In some cases, friends or relatives may contribute money, assets, or even expertise to help start or grow the business. So what are the external sources that small businesses can use? They can use trade credits. These are often short-term credit from suppliers, typically for 30 to 60 days. It's commonly used to purchase inventory or spare parts or short-term purchases and is usually interest-free if you paid on time. And then they can use bank overdraft. Bank overdraft allows a business to withdraw more money than it has in its bank account, up to a set limit though. Ideal for short-term needs, but the interest are charged daily on the overdrawn amount. Also, they can use term loans, medium to long term, 20 to 20 years, etc. And say for example, a delivery van can be purchased on a 7-year term loan. These are usually unsecured loan. So if you want to buy a property or something like that, they usually are secured with the collateral such as a mortgage on the owner's home. And also they have the leasing or hiring option. Instead of buying expensive assets, businesses can lease them like vehicles, computers, or premises. Leasing avoids large upfront payments and spreads the cost over time. In this table, we talk about the different sources of finance and their advantages and disadvantages. So if you use owner's capital, they're readily available, quick and convenient, but you don't have to pay interest. But the disadvantage is the owner might not have enough money or savings, or may need that money for personal use, and once the cash is gone, until you make a profit, it's gone. And retained profits are the same it's again similar to owner's capital. And family friends, again, it's low interest. Money may not be need. Sometimes you probably don't need to pay back, sometimes you need to, but money, the disadvantage can be money may be lost if the business fails. Overdraft is quick access, allows emergency purchases. The disadvantages are high interest rates, is only a short-term solution as well. So please go through the list and familiarize yourself with the terms and various of finance sources. So let's talk about some term loans. And when a business take a term loan, what sort of an interest is supposed to pay? So there are two types of interest on a term loan: flat rate of interest and the reducing balance interest. Under the flat rate method, interest is calculated on the full amount borrowed, the principal for the entire long term. This means the total interest cost stays the same each period, regardless of how much has been repaid. Reducing balance interest method, interest is calculated on the outstanding loan balance, not the original amount. As you make repayments, the balance reduces, and so does the interest charge. This method is often cheaper overall, but not all lenders offer it. So in these two tables, we have a look at the flat rate interest rate calculation and reducing balance interest rate calculation. So the loan amount is $12,000 and the flat rate interest rate is 10% per annum. So under flat rate, you pay equal interest in 1 to 3 years, end up paying $3,600. Under reducing balance method, you still, the loan amount is $12,000 and 10% interest, but you only pay amount owing to the bank year 2 and year 3, which reduces the total interest payable to $2,400. So even though you take the term loan for 10% under flat rate, actually the effective rate of interest, the real cost of borrowing money, is more than that 10%. So you will only pay 10% in year 1, but if you really calculate what you owe to the bank and how much you're paying for as interest, in year 2 you end up paying 15%, and year 3 you end up paying 30%. So you can use this formula to calculate the effective rate you're actually paying under the flat rate. So in this scenario, if you put the $12,000 loan payment at a 10% flat rate, so you will end up paying 19.35% in real practical world. So if we, as an approximate, there's a strategy to calculate the effective rate formula. So there's a suggestion that you simply double the flat rate to get the effective rate. So in this example, the flat interest rate is 10%. If you simply double it, is 20%. So the actual effective rate formula is 19. The rate is 19.35%. So pretty close. However, the accuracy of the doubling method will depend on the variables involved, such as the number of repayments per year and the total period of the loan. So next, let's talk about what a small business need when applying for finance. To apply for finance, a business must provide documents like income proof, bank statements, and records of assets and liabilities. Sometimes they may have to provide the potential tax returns or business records as well. Lenders may also check the owner's personal credit rating, which reflects their ability to repay debt. That is very, very important. Every single bank or finance institution. Even if you're going to get a credit card, they will check this credit rating. Unless you have a good record, it's highly likely they will reject your request. A credit rating is influenced by income, expenses, existing credit payment history, and financial records. Maintaining good financial habits and repaying loans on time helps improve credit ratings and increases the chance of getting future finance. So, small business owners need to provide some other financial reports as well, such as budgeted cash flow statements and balance sheet. The cash flow statements compares receipts and repayments, showing that the business can cover loan repayments. The balance sheet outlines assets and liabilities, and if the business is highly geared, that means if the business is highly relying on borrowed fund, lenders may refuse additional finances. So let's talk about the gearing. Gearing refers to the level of a business's debt compared to its equity capital. It shows how much a company relies on borrowed money to finance its operations. So in this table, business A has so both businesses, business A and business B, has the same amount of assets, which is $200,000, but business A's liability is only $20,000. Business B's liability is $160,000. This means the business A is relying mostly on the owner's funds, which has $180,000. Business B, with the same $200,000 in assets and has $160,000 in liabilities and just $40,000 in owner's equity. This indicates high gearing as it depends heavily on borrowed money. Although both businesses own the same value in assets, they are financed very differently, one through equity and the other largely through debt. Let's talk about the debt ratio. The debt ratio is a financial metric that compares a company's total liabilities to its total assets. It shows the proportion of a business assets that are funded through borrowing. For example, business A funds only 10% of its assets using debt, indicating a low reliance on external financing. In contrast, business B covers 80% of its assets with borrowed money, making it more highly geared and financially riskier. Generally, a high debt ratio signals greater financial risk, as the business must generate enough cash to meet repayment obligations. Before seeking additional funding, business owners should examine their current debt levels. Lenders often avoid highly geared companies because they are considered too risky to support. So what is return on owner's investment means? In simple terms, we call it ROI. Return on investment shows the percentage profit an owner earns from their investment in the business. It's calculated by dividing net profit by the total investment cost and multiplying by 100. In this case, in this example, the net profit is $5,000, owner's equity is $50,000. So the ROI is 10% per annum. ROI helps assess how successful the owner's investment has been by comparing profit to the amount of personal funds invested. Let's recap what we learned so far. Small business owners have access to two main types of finance: internal finance, such as owner's own capital, retained earnings, and help from friends and family. External finance like bank loans and trade credit is sourced from outside parties. Choosing the right type of finance depends on the specific needs and circumstances of the business. For example, loans require repayment of both the original amount and interest. Flat rate interest is calculated on the full amount borrowed throughout the loan period. Reducing balance interest is charged only on the outstanding balance, which decreases over time. While borrowers often prefer this method, it's not always available. It is important for business owners to calculate the effective interest rate, which reflects the true cost of borrowing. To secure a loan, banks usually ask for supporting financial documents such as the cash budget and balance sheet. Gearing refers to how much a business relies on borrowed funds. A highly geared firm carries a lot of debt, which increases financial risk. A lowly geared firm relies less on loans and is generally seen as safer. Banks may decline loan applications from businesses that are over-reliant on debt. However, while high gearing increases risk, it can also lead to a higher return on the owner's investment, ROI, if the business performs well. As I mentioned at the beginning of this video, please pause the video, read the question, try answer it your own, and then review the answer. So in this question, there are two types of businesses, plumber and doctor. The question is asking, list the current assets and how these businesses going to finance these current assets. Say, for example, plumber, the current assets can be pipe and fitting inventory. These can be financed through trade credit. And mobile phone can be financed through short-term loan or cash. Uniforms and protective gear can be business credit cards or cash. Doctors' medical supplies can be trade credit. Billing software license can be subscription via subscription. Operating leases and reception computer system equipment, again financed through lease. So non-current assets for plumber, workman, pipe cutting equipment, office computers can be financed through bank loan, hire purchase or lease. Doctors' non-current assets which are usable for more than 12 months are examination tables, medical instruments, waiting room furniture can be financed through bank loans or equipment finance, hire lease, etc. So question B is the reasons for recommendations are matching asset life. So the recommendations for the assets and the source of finance is matching asset life with the loan length. For example, long-term assets like vans and tables should be financed over a longer period, not through the overdraft, because you have to pay back the overdraft soon while you can use the assets for longer as non-assets. Protecting cash flow as well, leasing and trade credit reduce the need for large upfront payments, keeping working capital available for emergencies of the business. Flexibility and upgradability. Leasing computers and software allows easy upgrading as technology changes. Risk management. Leasing reduces the risk of owning obsolete or broken equipment. And cost efficiency. Short-term purchases should avoid expensive loans. Instead, use cash or short-term credit to prevent interest build-up. So this question is about Janet is deciding whether to buy or lease a $30,000 worth of car for her business. She has $5,000 in cash and can take a loan for the rest at 10% flat interest over 3 years. Alternatively, she thinks she can lease a similar car for $100 per week over the same period. So let's have a look. So the question is asking advantages and disadvantages on these different finances. So advantage are Janet owns the car after buying and can sell it later to recover some money. Disadvantage is she takes on a larger loan and interest cost is high. That means $7,500 over 3 years. Leasing advantage can be lower regular payments, predictable cost, and no worry about selling the car. The disadvantage is no asset ownership. After 3 years, she has no car and no resale value. She'll have to probably hire another car. So question B is calculate the cost of leasing the vehicle. So lease cost is $100 per week in here. So number of weeks in 3 years is 52 weeks times 3, which is 156 weeks. So the total lease cost is 156 times $100, $15,600. So the lease in the car would cost her $15,600 over 3 years. Question C, find the loan details for buying the car. So car price is $30,000 and she can deposit $5,000. So the amount to borrow is $25,000 after deducting $5,000 deposit she pays. So loan interest rate is 10% flat per annum for 3 years. So the interest per year would be $25,000 at 10%, $2,500 per year. So total interest for 3 years would be 2,500 times 3 is 7,500. That's the interest she has to pay. So calculate the total cost of purchasing the car. So 25,000 is the price of the car and 7,500 is the interest that she has to pay. This would give her 32,500, the total repayment. And then she has also paid deposit. So you have to add that $5,000 into 32,500. So the total cost of ownership. So if she buys the car, the cost for that is $37,500. But after 3 years, she sells the car for $20,000. So the net cost for her would be $37,500 minus $20,000. So net cost is owning the car is $17,500. So in this table, you will see under lease option, like hiring the car, she would be paying $15,600 over 3 years, but no ownership at the end. But if she buys the car through a loan, her cost is $17,500 after selling. So she owns the car and she can sell it like after selling. So what is the recommendation for Janet? The total cost of leasing the car over 3 years would be $15,600. Leasing offers predictable payments, no responsibility for resale, and generally lower cash flow demands. However, at the end of the lease, Janet would not own the vehicle, meaning she would need to lease or buy another car if she wants to continue having a vehicle for her business. Buying the car would involve a $5,000 deposit and a $25,000 loan at a flat 10% interest rate. Over 3 years, the total repayments including interest would be $37,500. After reselling the car for an estimated $20,000, the net cost of purchasing would be $17,500. Although the cost is slightly higher than leasing, Janet would own the car during this period and could sell it to recover some funds. So recommendations are: leasing appears to be the better financial decision for Janet if her priority is minimizing overall cash outflow and avoiding the risks associated with owning and reselling a car. However, if Janet values ownership or expects to keep the vehicle beyond 3 years, purchasing may be worthwhile despite the slightly higher cost. So given the information, I recommend leasing the car to keep business cash flow healthy, avoid debt obligations, and eliminate the risks tied to depreciation and resale. In this question, Debbie is thinking of taking a $6,000 loan to buy a computer server for her business. The bank offers the loan over 4 years with monthly repayments and at a flat interest rate of 10%. In a flat rate, how financial institutions apply flat rate interest to loans? In a flat rate loan, the interest is calculated on the original principal for the entire term, regardless of how much of the loan has already been repaid. So even as Debbie repays part of the loan, the interest remains fixed based on the full $6,000 for 4 years. So the total amount of interest that Debbie would pay is $6,000 is the loan amount at 10%, $600 per year. So over 4 years, $2,400. The total amount she would pay if she takes out the loan. The loan principal is $6,000 and interest is $2,400. The total repayment is $8,400. So the monthly repayments would be, in 4 years we have 48 months. So monthly repayment is $8,400 divided by 48, $175 per month. This is including both principal and interest. So what accounting report should Dorothy prepare? Debbie should prepare a cash budget to show she can meet the monthly loan repayments, where she can show receipts and repayments. So a cash budget will show expected cash inflows and outflows, helping prove she has enough cash to cover the $175 prepayment. So this is regarding a flat rate of interest. Is the real cost of so what is the effective rate of interest? You can apply her loan details to the formula that we talked about. So even though she's been given 10% per annum, her real borrowing cost would be 22%, not 10%. I hope you remember I mentioned that we can just double up as a strategy. We can just double up the flat rate to get the effective rate. So in this case, 10% double up is 20. Again, it's pretty close to what we discussed. And the actual rate is estimated effective rate is 22%. In this question, Jake Knight is applying for a $10,000 loan to purchase a motorcycle for his courier business. The bank offers a 4-year loan at a 12% flat annual interest rate. This has to be repaid in 48 equal monthly installments. So we write down the loan details. The loan amount is $10,000. Loan term is 4 years. In months it's 48 and interest rate is 12% per annum at the flat rate. Question A is calculate the total cost of interest on the loan. So So loan amount is $10,000 at 12%. He paid $1,200 per year, and over 4 years he'll paying $4,800. Calculate the total amount to be repaid under the conditions of the loan. So the total repayment is equal to principal plus total interest. So the principal of the loan amount is $10,000. The interest for 4 years is $4,800. So the total amount Jack will repay is $14,800. Monthly repayment is $14,800 divided by 48, which is the number of months, will be $308.33 per month, both capital and interest. Calculate the effective rate of interest. Put the details in the formula, and it will come as 23.43. Again, our strategy, doubling up the flat rate, 12%, which is 24, and pretty close to 23.43. So explain the advantage of a loan with interest on the reducing balance instead of flat rate interest. So with a reducing balance loan, Jake pays interest only on the remaining loan balance. So his interest charges decreases over time, resulting in lower total interest. In contrast, a flat rate loan charges interest on the full loan amount for the entire term, leading to higher overall interest. Therefore, the reducing balance method is usually more cost-effective in the long run. In this question, Vincent N. plans to buy a business property and has saved $55,000 as a deposit. He applies for a $545,000 mortgage from the bank at 6% interest to be repaid over 25 years. The bank will calculate interest daily and charge it monthly, with monthly repayments of $3,512. So question A is, what is a mortgage loan? A mortgage loan is used to buy real estate with the property acting as collateral. The borrower repays the loan in monthly installments covering both principal and interest over a long term, usually 15 to 30 years. If repayments aren't made, the lender can reclaim the property through foreclosure. The question B is, does the 6% refer to flat rate or reducing balance interest? Explain how this interest will be applied to the loan. So the 6% interest rate mentioned in Vincent N. case refers to a standard annual interest rate. But since the bank states that interest will be calculated daily and charged monthly, this indicates a reducing balance interest method, not a flat rate. With reducing balance interest, interest is calculated daily on the outstanding loan amount, the principal that remains unpaid. As Vincent makes monthly repayments of $3,512, part of each payment goes toward interest and the rest reduces the principal. Over time, as the principal decreases, less interest is charged because the amount owed is smaller. This method is more cost-effective than flat rate interest because total interest paid declines over the loan period. So although the rate is fixed at 6%, the reducing balance method makes the loan progressively cheaper and as it's repaid. Question C, calculate the total cost of the loan to N. Loan amount is $545,000, monthly repayment is $3,512. So long term is over 25 years, means in months 300 months, 25 years times 12. So the total repayments over the life of the loan is 3,512 times 300 is $1,053,600. So the total interest paid is $1,053,600 minus $545,000 is the loan amount that he borrowed. So the balance is $508,600 is the interest that he is paid. The total cost to the end is $1,053,600, both principal and interest over 25 years. So would there be an advantage to N if he made fortnightly repayments instead of monthly ones? Explain your answers. Yes, making fortnightly repayments would likely reduce the total interest paid and shorten the term loan. Here's why. Monthly repayments, there are only 12 payments per year. But when you do fortnightly repayments, half monthly, you make 26 payments per year, which is an equivalent to 13 full months payments per year. This means N would effectively make one extra month's payment each year, which would go toward reducing the principal faster. Since interest is calculated daily, paying down the loan more frequently reduces the balance sooner and results in less interest charge overall. So this graph will show you how the loan repayments at the flat rate, the monthly versus fortnightly repayments. So these are more details in here, more calculations that you can compare monthly and fortnightly repayments. If you paid monthly, it would be $1 million, 53,600. But if you paid fortnightly, the repayment amount would be only 960,532. The interest you will end up paying only 415,000. So instead of he takes 25 years to pay, if he pays fortnightly, it would only take him 21 years to repay. So the saving by switching to fortnightly is he can save the interest of 93,000 and he can shorten the long term by 4 years as well. So this question is about debt ratio. The question is, United Earth Moving has total assets of $250,000 and owner's equity of $200,000, meaning its total liabilities are $50,000. 250,000 minus 200,000 is equal to 50,000 is total liabilities. Calculate the debt ratio for this business. So the debt ratio is assets financed through the debt. This is 20%, 50,000 total liability divided by the total assets. So 20%. This indicates a low risk financial position with strong reliance on owner's equity and minimal dependence on borrowing. This pie chart visually represents United Earth's moving financial structure, showing that 80% of the business is financed through owner's equity and only 20% through debt, indicating a strong and stable equity position. So in this question, St. Kilda Board Hire has So in this question, we compare two businesses, asking for you to compare two businesses and its financial position, balance sheet, assets, and liabilities. So in this table, you can see Sammy's panels has the total assets, liabilities, owner's equity, and debt ratio, and Sue's Body Shop total assets, liabilities, owner's equity, and debt ratio and working capital ratio as well. So number one, liquidity. Semi panels has a working capital ratio of 0.94 to 1, meaning current liabilities slightly exceed current assets, indicating possible cash flow issues. Sue's Body Shop, with the ratio of 2.75 to 1, shows strong liquidity and the ability to easily meet short-term obligations. Number 2 is gearing. Semis has a high debt ratio of 66.8%, meaning 2/3 of its assets are funded by debt, increasing financial risk. SOS has a lower debt ratio of 35.1%, suggesting moderate debt use and less financial strain. Overall financial risk. What is the overall financial risk in this two business? Semis panel is financially riskier due to tight liquidity and high gearing. It may face difficulties with repayments and needs to improve cash flow or equity. In contrast, Sue's Body Shop is financially stable with strong liquidity and manageable debt, giving it more flexibility for growth. In this question, we're talking about return on owner's investment, ROI. So J's ROI is 12.5%, calculated by dividing a $5,000 profit by a $40,000 investment and multiplying by 100. Compared to typical low-risk returns like bank deposits, which is 3 to 5%, or even average share market return, 7 to 10%, J's ROI is strong. However, his paintball business carries high risk, such as seasonal demand and competition. So the conclusion is, while the 12.5% ROI is attractive, it reflects the greater risk and uncertainty of running a small niche business versus safer investment options. So Harry Koch earns a profit of $30,000 as the proprietor of Western Pool Tables, while Dave earns $40,000 operating a deluxe pool and billiards. Which business owner has the higher profitability? Use examples to explain your answer. On absolute dollar terms, Dave is more profitable. Like when you look at it, it's $40,000 is more than $30,000. So he pockets $40,000 versus Harry's $30,000. So Dave earns $10,000 more profit. So illustrative example is, you can see below, same revenue scenario. Let's say each business has $100,000 in sales. So the Harry's profit margin would be $30,000 divided by 100,000 sales, 30%. So Dave's is 40%. So Dave also has a higher profit margin. Let's talk about the ROI. Suppose each business put $50,000 on their own money to the business. So the profit is $30,000 divided by 50,000. Harry's ROI is 60%. Dave's ROI is 80%. So Dave's earning a greater return on the same capital. That means higher the risks, higher the return. In both common profitability measures, profit margin and return on owner's investment, Dave's business outperforms Harry's because he generates more profit for each dollar of sales or equity. So question is asking, in this question is asking owner's equity. owner's equity is equal to assets minus liabilities, so which is AC Electricals 125,000 minus 25,000, 100,000 owner's equity, and Acme has $75,000 owner's equity. Debt ratio, liability divided by assets. ACE is 20%, Acme is 40%. Return on owner's equity investment 20% ACE and 26.7% Acme. So because both firms earn $20,000 profit on the same asset base, but Acme uses more debt, 40% gearing, reducing its owner's equity to $75,000 compared to ACE's $100,000. As a result, Acme's ROI higher at 26.7% versus ACE's 20% because the profit is divided by a smaller equity base. So the conclusion here is higher gearing can amplify returns on owner's equity but also increases the financial risk. In this question, Sharon is considering buying a business property for $900,000. She has saved $80,000 for a deposit and needs to borrow $820,000 at an interest rate of 7% per annum over 25 years with monthly repayments. She wants to know the total cost of the loan over time, including interest. You're also asked to use a mortgage calculator from a major Australian bank like Commonwealth, NAB or Westpac to estimate her monthly repayments, total loan cost and total interest paid. So I prepared two interactive tables here based on the questions. Like you can go online and use any of the top 4 banks interest calculators and you can work out yourself at different scenarios. Under the description, interest on 820k over 25 years, how much the loan repayment would be, etc. So other factors to be considered when choosing a loan is Sharon should consider more than just interest. Key factors include monthly affordability, loan flexibility. Example, if there's an offset accounts to reduce the interest amount, and rate type, whether it's fixed or variable, and associated fees, her financial goals, and risk tolerance. She must also weigh the opportunity cost of using or saving her deposit. These elements together help determine the most suitable and sustainable loan option. In this question, Jane, who runs a mobile hairdressing business, wants to replace her unreliable vehicle costing $25,000. She has $6,000 in her business account and is considering using a $20,000 overdraft facility from her bank to fund the rest. The question asks why this financing method is inappropriate and requests alternative financing options she could consider. So using an overdraft to buy a $25,000 van is inappropriate because overdrafts are short-term, expensive, and designed for temporary cash flow needs, not for long-term assets. The mismatch between the loan term and the vehicle's useful life creates financial risk. It also reduces Jane's cash buffer, increases interest costs, and limits her borrowing flexibility. A more suitable option would be a term loan or vehicle finance that aligns better with the asset's lifespan. So these are the real exam style questions that we started talking about. So the other better alternatives for financing a business vehicle are listed below. She can go for chattel mortgage. It's pretty similar to hire purchase or lease as well. Hire purchase, operating leases, equipment finance, trade-in sale, or term loan facility. So the recommendation is that I would recommend that Pinkman arrange either a chattel mortgage, type of a secured loan used to purchase a movable business asset such as vehicle, or hire purchase for the new salon vehicle. She gets a fixed rate and fixed monthly payments over the asset's life. The facility is secured by the van itself. Lender's risk is low, so rates are lower than an overdraft. She preserves a working capital buffer in the business account for day-to-day expenses rather than eating it up on the spot. This way, her finance matches the life of the asset, cash flow is predictable, and she avoids the high variable rates and recall risk of an overdraft. In this question, opening inflow of $20,000 appears under financing receipts. So answer is when Jordan takes out $20,000 on a 5-year loan, it shows up differently in his cash flow. So in his cash flow, the loan would go under financing receipt as a receipt in cash in from the bank, and each repayment date, the repayment would go again under financing payment as a cash outflow to the bank, principal plus interest. So what will show under his income statement? Interest expenses reduces profit each year by whatever interest accrues on the outstanding balance. Principal itself doesn't hit the P&L, it simply converts cash into a reduction of liability on the balance sheet. But depreciation of the new equipment, on the other hand, also reduces the profit, reflecting the asset's consumption. So everything, putting it together, cash flow, $120,000 immediately. He will save it, and interest and principal amount will be paid regularly over 5 years. In profit and loss, interest payment will be accounted for, and the depreciation of the new assets in each period will be accounted under profit and loss account as well. By separating cash out from expenses, Jordan's accounts will show healthy cash availability upfront, but his annual profit will be lowered by the financing cost of interest and the wear and tear of the new assets depreciation.